Here's something that will surprise you. Predicting market crashes is actually easier than predicting market rallies. I know that sounds backwards, but it's true. Bull markets can continue far longer than anyone expects, driven by momentum, speculation, and investor psychology that defies rational analysis. But bear markets almost always follow predictable patterns, triggered by identifiable imbalances that build up over time until they reach a breaking point. I've been running JPMorgan Chase for over 20 years, and I've managed through some of the most devastating market crashes in history. The dot-com bubble in 2000, the financial crisis of 2008, the flash crash of 2010, the European debt crisis, the pandemic crash of 2020. And in every single case, the warning signs were there months or even years before the crashes occurred. The problem wasn't that the signals were hidden. The problem was that most investors chose to ignore them. At JPMorgan Chase, we've built our entire risk management philosophy around identifying these warning signs early and positioning defensively before crashes become obvious to everyone else. We don't try to time market tops perfectly. That's impossible. But we can identify periods when the probability of significant market declines is much higher than normal, and we can position our portfolios to protect capital and even profit from market stress. The investors who preserve wealth during bear markets aren't the ones who predict exact timing. They're the ones who recognize dangerous conditions developing and gradually reduce risk before everyone else panics. They're selling when others are still buying, raising cash when others are still reaching for yield, building defensive positions when others are still chasing growth. Today, I want to share with you the specific warning signals I monitor to identify periods when major market drops become highly probable. These signals have helped JPMorgan Chase not only protect our capital during market crashes, but position ourselves to acquire distressed assets and strengthen our competitive position when our competitors were struggling. The first warning signal I always watch is credit market deterioration. Just as credit market healing signals that market recoveries are coming, credit market stress signals that market declines are building. Credit markets are where the real economy intersects with financial markets, and they're often the first place where fundamental problems become visible. When businesses start having trouble accessing credit, when banks become more restrictive in their lending standards, when corporate bond spreads start widening consistently, it's a sign that underlying economic conditions are deteriorating. And when economic conditions deteriorate, stock prices almost always follow. During the lead up to the 2008 financial crisis, credit markets started showing stress as early as 2006. Subprime mortgage defaults were rising, banks were tightening lending standards, and credit spreads were starting to widen. Most investors ignored these signals because stock prices were still rising, but the credit market stress was a clear warning that fundamental problems were developing. The same pattern appeared before the dot-com crash. In 1999 and early 2000, technology companies were having increasing difficulty accessing credit markets for anything other than stock-based transactions. Banks were becoming nervous about lending to companies with no profits and questionable business models. Credit spreads for speculative-grade companies started widening months before stock prices peaked. At JPMorgan Chase, we monitor credit conditions constantly through multiple indicators. We track corporate bond spreads, particularly high yield spreads relative to treasury bonds. We monitor our own lending standards and those of other major banks. We watch commercial paper markets, which are crucial for short-term corporate funding. We analyze loan loss provisions and charge-offs across the banking system. Here's how to monitor credit market deterioration. Watch high-yield credit spreads relative to treasury bonds. Widening spreads indicate increasing credit stress. Monitor bank lending standards surveys conducted by the Federal Reserve. Pay attention to corporate bond issuance volumes and pricing when companies start paying higher rates or avoiding bond markets altogether. It's a warning sign. Track commercial paper markets and money market fund flows. The second warning signal is monetary policy tightening beyond what the economy can handle. When central banks raise interest rates or reduce monetary accommodation, it eventually slows economic growth and reduces asset prices. But the key is recognizing when monetary tightening is becoming excessive relative to economic fundamentals. This is more art than science because the effects of monetary policy changes take months or even years to fully impact the economy. But there are patterns that repeat across different cycles. when the Federal Reserve raises rates rapidly, when they invert the yield curve by raising short-term rates above long-term rates, when they start reducing their balance sheet aggressively, these actions create stress in financial markets that eventually leads to broader economic problems. The 2000 dot-com crash was preceded by aggressive Federal Reserve tightening. Fed Chairman Alan Greenspan raised rates from 4.75% to 6.5% between June 1999 and May 2000, specifically because he was concerned about stock market speculation and asset bubbles. That tightening eventually contributed to the recession and market crash that followed. The 2008 financial crisis was also preceded by Federal Reserve tightening, though the dynamics were more complex. The Fed raised rates from 1% to 5.25% between 2004 and 2006, which helped trigger the subprime mortgage crisis that eventually led to the broader financial system collapse. But it's not just about interest rate levels, it's about the pace of change and the relationship between monetary policy and economic conditions. When the Fed is raising rates faster than the economy can handle, when real interest rates become too high relative to economic growth prospects, when monetary policy starts constraining credit creation, these conditions often precede market declines. At JPMorgan Chase, we spend enormous resources analyzing Federal Reserve policy and trying to understand not just what they're doing, but whether their actions are appropriate for current economic conditions. We monitor real interest rates, yield curve shapes, money supply growth, and bank reserve levels. Here's how to monitor monetary policy warning signs, track the federal funds rate relative to economic growth rates and inflation, monitor yield curve shapes, particularly when short-term rates exceed long-term rates, watch Federal Reserve balance sheet changes and money supply growth rates, pay attention to central bank communications for signs of increasing concern about asset prices or economic imbalances. The third warning signal is excessive valuation levels across broad market segments. When stock prices rise far above levels that can be justified by underlying business fundamentals, it creates conditions where even small disappointments can trigger significant market declines. But identifying excessive valuations isn't just about looking at price to earnings ratios or other simple metrics. It's about understanding the relationship between current valuations and long-term economic prospects, the sustainability of current profit margins, and the appropriateness of current discount rates given monetary policy and economic conditions. During the dot-com bubble, many technology stocks were trading at 50, 100, or even 200 times earnings if they had earnings at all. These valuations were clearly unsustainable, but they persisted for years because investors believed that traditional valuation metrics didn't apply to new economy companies. When reality set in, stocks fell 70% to 90% from their peaks. The same pattern appeared before the 2008 financial crisis, though it was less obvious because it involved financial sector stocks rather than speculative technology companies. Banks were trading at historically high multiples of book value, even though their business models were becoming increasingly risky and their balance sheets increasingly leveraged. At JPMorgan Chase, we use multiple valuation frameworks to assess whether current market levels are sustainable. We look at traditional metrics like price to earnings ratios, price to book ratios, and dividend yields, but we also analyze more sophisticated measures like enterprise value to EBIT, price to sales ratios adjusted for profit margins, and discounted cash flow models. We also pay attention to valuation dispersion when certain sectors or market segments become dramatically overvalued relative to others. It often signals that speculation is driving prices rather than fundamental analysis. During the dot-com bubble, technology stocks were trading at massive premiums to value stocks. During the housing bubble, home builder and financial stocks were trading at huge premiums to defensive sectors. Here's how to monitor valuation warning signs, track broad market valuation metrics like Shiller P ratios and market capitalization to GDP ratios, monitor sector rotation and relative valuations between different market segments, pay attention to new issue activity and IPO valuations. When speculative companies are going public at extreme valuations, it often signals market tops. The fourth warning signal is leverage extremes throughout the financial system. When businesses, financial institutions, and individual investors are borrowing excessively relative to their income or assets, it creates fragility that can turn small problems into system-wide crises. Leverage amplifies everything, both gains and losses. During good times, leverage makes everyone look smart because rising asset prices cover up underlying weaknesses. But during stress periods, leverage forces selling at exactly the wrong time, which drives prices down further and creates more forced selling. The 2008 financial crisis was fundamentally a leverage crisis. Investment banks were leveraged 30 to 1 or more. Homeowners were buying houses with no money down. Financial institutions were creating complex derivatives that multiplied their exposure to mortgage markets. When mortgage prices started falling, the leverage in the system amplified those losses until they threatened the entire global financial system. But leverage builds up gradually over time, often in ways that aren't immediately obvious. It shows up as increased margin debt among individual investors, higher debt-to-equity ratios among corporations, more complex financial products that embed leverage, and creative financing structures that allow people to control assets with less capital. At JPMorgan Chase, we monitor leverage levels across multiple dimensions. We track margin debt levels among retail investors, corporate debt to EBITDA ratios across different sectors, bank capital ratios and off-balance sheet exposures, and household debt to income ratios. We also monitor more subtle forms of leverage embedded in derivative contracts, structured products, and alternative investment vehicles. We pay particular attention to leverage in areas that could affect broad market stability. When hedge funds are using significant leverage, when banks are expanding their balance sheets rapidly, when corporate borrowing is increasing faster than cash flow generation, these trends often precede periods of market stress. Here's how to monitor leverage warning signs: track margin debt levels published by NYSE and FINRA, monitor corporate debt to equity ratios and interest coverage ratios across different sectors, watch bank leverage ratios and off-balance sheet growth, pay attention to household debt levels and debt service ratios published by the Federal Reserve. The fifth warning signal is speculative behavior and market euphoria. When investors start believing that traditional risk management principles don't apply, when this time is different becomes conventional wisdom, when speculation overwhelms fundamental analysis, these conditions often mark market tops. Speculative behavior shows up in many forms. Day trading volumes spike, options activity increases dramatically, meme stocks and momentum investing dominate market discussions, IPO and SPAC issuance reaches extreme levels, and investors start borrowing money to buy speculative investments. During the dot-com bubble, day trading became a cultural phenomenon, with people quitting their jobs to trade stocks full-time. Online brokerage advertisements showed ordinary people becoming rich through stock trading. Investment clubs proliferated, and financial media devoted enormous coverage to stock picking rather than fundamental analysis. The same patterns appeared during the 2020-2021 meme stock phenomenon, though social media amplified the speculation beyond anything seen in previous cycles. Individual investors were driving massive price movements in companies like GameStop and AMC, often based on social media posts rather than financial analysis. Options trading volumes reached record levels, and special purpose acquisition companies, SPACs, became a popular vehicle for speculative investments. At JPMorgan Chase, we monitor multiple indicators of speculative behavior. We track retail trading volumes and options activity, IPO and SPAC issuance levels, margin debt growth, and social media sentiment indicators. We also monitor our own client behavior for signs of increasing speculation or risk-taking. We pay particular attention to the quality of new companies going public and the valuations at which they're being sold. When companies with questionable business models are going public at extreme valuations, when SPACs are proliferating, when investment bankers are having difficulty finding enough high-quality deals to meet investor demand, these are signs that speculation is overwhelming prudent investment analysis. Here's how to monitor speculative behavior. Track retail trading volumes and options activity relative to historical norms. Monitor IPO and SPAC issuance volumes and average valuations. Watch margin debt levels and retail investor survey data. Pay attention to social media sentiment and meme stock activity. The sixth and final warning signal is earnings deterioration and guidance reductions across broad market segments. While stock prices can remain elevated for extended periods despite fundamental problems, earnings eventually reflect underlying business reality. When earnings start declining across multiple sectors, when companies start providing negative guidance, when profit margins come under pressure, these developments often precede broader market declines. But you have to distinguish between cyclical earnings fluctuations and structural earnings deterioration. Every business cycle includes periods when earnings growth slows or declines temporarily. The warning signal comes when earnings problems become broad-based and persistent, when companies start warning that their challenges are more serious than temporary cyclical headwinds. During the lead up to the 2001 recession, technology companies started reporting disappointing earnings and reducing guidance throughout 2000, even while stock prices remained near their peaks. Companies that had been reporting explosive earnings growth suddenly found that demand for their products was slowing, competition was increasing, and their business models were less sustainable than investors had believed. The same pattern appeared before the 2008 financial crisis. Financial sector companies started reporting credit losses and reducing guidance throughout 2007, even though stock prices didn't peak until late in the year. Banks started taking write-downs on mortgage-related investments. Insurance companies started reporting underwriting losses, and consumer finance companies started seeing higher default rates. At JPMorgan Chase, we monitor earnings trends across our own business lines and across the broader economy. We track earnings revisions, ratios, forward guidance trends, profit margin analysis across different sectors, and leading indicators of business conditions like employment growth and capital spending. We pay particular attention to earnings quality, not just whether companies are meeting expectations, but how they're meeting them. When companies start using aggressive accounting practices, when they start relying on financial engineering rather than operational improvements, when their earnings growth becomes disconnected from revenue growth, these are signs that reported earnings may not reflect underlying business reality. Here's how to monitor earnings deterioration: track consensus earnings estimates and revisions across major market indices, monitor forward guidance trends during earnings seasons, watch profit margin trends across different sectors, pay attention to earnings quality indicators like the relationship between earnings and free cash flow. Now let me explain how these 6 warning signals work together to create conditions for major market declines. Just like the signals for market rises, the most dangerous periods occur when multiple warning signals align simultaneously. The most devastating market crashes typically happen when credit markets are stressed, monetary policy is tightening, valuations are excessive, leverage is extreme, speculation is widespread, and earnings are deteriorating all at the same time. The 2000 dot-com crash, the 2008 financial crisis, and several other major market declines all featured this convergence of multiple warning signals. But here's what's crucial to understand. These signals don't tell you exactly when markets will decline or how severe the declines will be. They tell you when conditions are becoming dangerous and when the probability of significant market stress is much higher than normal. The appropriate response to seeing multiple warning signals isn't to sell everything and go to cash. It's to gradually reduce risk, increase defensive positions, and prepare for potential market volatility. This might mean reducing equity allocations, increasing cash reserves, avoiding speculative investments, and focusing on high-quality companies with strong balance sheets. At JPMorgan Chase, we use these warning signals to guide our risk management decisions and our advice to clients. When we see multiple warning signals developing, we become more defensive in our positioning, more selective in our investment choices, and more focused on capital preservation rather than growth. The most important lesson from 4 decades of monitoring these signals is that successful investing isn't about predicting market crashes with perfect timing. It's about recognizing dangerous conditions and positioning yourself to survive and thrive through whatever market environment emerges. Markets can remain overvalued longer than anyone expects. Speculation can continue far beyond rational levels, and dangerous conditions can persist for months or even years before they result in actual market declines. But when multiple warning signals are present, the wise investor prepares for volatility rather than assuming that current conditions will continue indefinitely. The investors who prosper over long time periods aren't those who try to time every market move perfectly. They're the ones who understand market cycles, respect the power of these warning signals, and position themselves conservatively when conditions become dangerous. They may miss some upside during the final phases of bull markets, but they preserve their capital during bear markets and position themselves to take advantage of the opportunities that market stress inevitably creates. These 6 warning signals have served me well throughout my career, helping JPMorgan Chase navigate successfully through multiple market cycles and emerge stronger after every crisis. They're not perfect predictors, but they're reliable indicators of when market conditions are becoming dangerous and when prudent investors should become more defensive in their positioning.